This is Netflix's price evolution for the past 5 years. As we all know, Netflix is one of the greatest companies in the stock market with extremely solid fundamentals and very high growth rates. As a result, its stock has risen sharply for the past years. However, you could have still lost money with Netflix. Imagine you bought at around here. It's a very solid entry price, it's not the best you could have gotten, and it's not the worst you could have gotten. Of course, if you held until today, you would have gotten a return of around 56.8%. However, this entails that you would have had to have held this stock through all the market turmoil, because there was a time when everyone started doubting Netflix because they started to lose some subscribers and their earnings started to slow down. If you would have panicked and you would have sold the stock at the bottom, you would have still lost around 60% of your position, meaning that in the stock market you could choose a great stock at a great price and still sell at a loss. Another example is Meta. Here is its price evolution for the past 5 years. And again, if you chose an average entry price over here, right now you would have made over 75% in return for this stock. However, Meta has also faced some market backlash as TikTok started to take over social media and they started to invest all their free cash flows into the metaverse instead of returning it to shareholders. If you as an investor would have sold at the bottom, you would have lost close to 70% of your investment on such a high quality company. But why did I give you these examples and why am I telling you all of this? Well, my point is that the average retail investor dedicates most of their time to research when they should be buying stocks instead of dedicating a lot of this time to research when they should be selling stocks. And don't get me wrong, I believe that researching when to buy stocks is extremely important. However, I feel like the majority of investors actually believe that the timing and the decision making of when to sell stocks is not important at all. In this study that I found, they conducted a survey on retail investors, and it showed that around 80% of the investors spent over 60% of their dedicated time to investing to research when they should be buying stocks, and close to 70% of these same investors dedicated between 0 to 30% of their time that they dedicated to investing to research when they should be selling stocks. But as we have seen with the previous examples, even if you bought some of the highest quality companies in the stock market such as Netflix, Meta, or Amazon, you could have still lost money if you didn't dedicate the correct timing in order to research when you should sell the stocks. Because one important thing to always keep in mind is that money is never made until you sell the stock. So today we'll be looking at some of the common reasons to sell stocks. So the three that I believe make the most sense are, first of all, when your investment thesis has changed. For example, when the fundamentals of the company have deteriorated. Second, when valuation does not reflect reality. Number 3 is that better opportunities may exist elsewhere. Your position may have run up too much and you see another investment opportunity. In some cases, it may actually make sense to take your money out of your existing position and put it to the new one. Number 4, for example, is when a company will be acquired. Maybe you're not a fan of that, or maybe they're paying a lower price than the one that you already have the company at. Well, in that case, you should probably sell. Number 5 is portfolio rebalancing, where some of your stocks may have run too much and their weighting inside the portfolio may be too high in comparison to your investment strategy. Reason number 6 may be changing economic conditions, for example, rising or lowering interest rates. Number 7 may be that you made a mistake in stock analysis. It happens to everyone. It has happened to me multiple times, believe me. And number 8 is due to personal circumstances. Maybe your car broke down and then you need to sell your stocks in order to be able to fix your car to get to work. Well, these are all common reasons to sell your stocks, and we will be focusing now on the top 3, starting with your investment thesis has changed. This is a real life example of a company that I was tracking very heavily a couple of years back. It was in the pharmaceutical industry. So imagine I bought at the position that says on the screen. So one of the most attractive things about this company was that they had a lot of cash on hand. And what they decided to do is to convert all of this cash into Bitcoin. Of course, the market got extremely excited, but I decided to sell because I wasn't comfortable holding this. What happened later is that Bitcoin then crashed because, of course, cryptocurrencies are extremely volatile. This is just a dumb example, but the point is that you shouldn't hold onto stocks where the investment thesis has changed and you're not comfortable holding them for a longer time period. There are thousands of stocks in the market and you'll find the one that suits you again. As Seth Klarman once said, ultimately nothing should be more important to investors than the ability to sleep soundly at night. Now, reason number 2 is that valuation does not reflect reality. This is the case that I was saying with Tesla. Well, imagine you bought at the start, just at the very beginning before the hype. and you decided to sell right when you believed that valuation started getting extremely crazy. For example, a price to earnings of 200 may have signaled already a red flag for Tesla. Well, if you decided to sell over there, you would have made, of course, a lot of money. And if you decided to sell today, you would, of course, have made a lot of money as well. However, from the time you sold all the way up to now, the stock has returned negative 14% in 3 years. Meaning that any big investment that you can think of, whether it's the S&P 500, whether it's investing in gold, in bonds, or in real estate, would have clearly outperformed your investment in Tesla. But is this negative 14% reasonable? Because Tesla is a lot better company right now than it was 4 years ago. Their revenues are extremely larger, their profits are even larger, and they're more efficient. The problem here was that valuation did not reflect reality 3 to 4 years ago. So although the company has improved so much and become a lot more valuable, the stock price has not managed to keep up because the PE ratio was so high that the company had a lot of room to grow without the stock actually being able to move any higher because it was still overvalued. So as Warren Buffett said, for the investor, a too high purchase price for the stock of an excellent company can undo the effects of a subsequent decade of favorable business developments. Now, reason number 3 is that you may have better opportunities elsewhere. For example, over here you can see the price movements of Crocs and Meta. Imagine you were holding Crocs because you were a long-time investor in Crocs, and you liked the fundamentals of Meta a lot more than you liked Crocs' fundamentals. Additionally, you believe that Crocs was trading at a PE ratio which was a bit too expensive for their growth rate, while Meta was looking at a discount in comparison to its peers. So you decide to sell your position in Crocs and move that cash all the way up to Meta. Well, in some cases, this can play off big time, because if you would have done this, look at the outperformance you would have had against Crocs. And this is based on the most wonderful principle of economics, which is opportunity cost. Now, one thing that I do want to highlight is that the longer you hold your stocks, the likelier you are to actually make money in the stock market. As you can see over here, this shows the frequency of the stock market being positive just by you holding on. If you would have held on to the S&P 500 for 1 month, there is a 63% probability that you would have made money. However, if you held it for 15 years, there is a 100% probability that you would have made money. As Warren Buffett and Charlie Munger always said, their favorite holding period is forever. What is my investing strategy and when do I decide when to sell a stock? Well, I'm trying to copy these two great investors by just buying companies that I'd be perfectly happy on holding them even if the market shut down for 10 years. Of course, I'm always tracking the development of my holdings, their annual reports, and all the information that comes from them, because in case their fundamentals actually deteriorate or I want to sell because of any other reasons, I'm able to do so. But I do have some investments where I've decided to set a time point in the future, which will allow me to rethink my position and check whether that stock should still be in my portfolio. What are your comments? Let me know down below. And of course, thank you for watching. As always, this has been the Cashflow Compounder. Join the Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic.